Okay, everybody, I guess this is the last topic, so this is your main event. US real estate, getting greedy when others are fearful. So when you mention US real estate, they sure are very fearful. But tonight, I'm going to tell you why. I'm going to give you 5 reasons why US real estate is not just a good idea for 2012, it is Wesvault's best idea for 2012. So let's get straight into it. We're going to go macro, and then we're going to go micro. We're going to look at the big picture, and then we're going to look why and where. So the first point is cycles. Real estate moves in cycles. This is a graph of the Singapore property market since 1960s to 1996. And as you can see, I like to point out the top of the market and the bottom of the market. The 98 bull market that you all have seen. In fact, this trajectory is quite common. I'd like to also give you an idea of what happened to the price here. In 1986, we dropped all the way down here and went back for a 6-year period. So prices went back 6 years. In 2000 here, one very big point that you need to note is anti-speculation measures implemented. Government got involved in the market. Was that the result of the crash? I don't know, but let's bring it back to 2011 and 2012 actually. Similar thing happening here in Singapore. One point down there is to remember where the price level is of the 98 crash. So the 98 crash, right up from 180 down to 100. 100 is 98 back to point here, 93. So prices went back about 6 years. They did not go back 60 years. You are not back here. In fact, that is a natural correction. So, one point with the cycles down here is very simple. If you had purchased property anywhere in the bottom of the cycle, here, you would have made money. Here, you would have made money. Here, you would have made money. But if you had purchased property in the top of 98, until today, maybe the last few weeks you would have made money, or if you own something at the orchard, but it's still not yet back there. So you can see the point of here is buy at the bottom of the cycle, and that property moves in cycles. So now, what is happening to the world? Where are we in the cycle in property? And why am I so concerned here in Asia? Let's take a look at Hong Kong. Look at that gangbusters right up there. Second guy, Australia, slightly coming down on the top, down here. Singapore, doing a little hop, skip, bounce over here, going up here. So, like I said, if you had bought at the top, maybe about now you would have made money. But after 10% came in, maybe not anymore. So, as you can see, all these markets, all along this part of the world, Asia Pacific, they're all at the top. I did not invent these numbers. One very interesting place, Britain. Coming here, as you can see, it came down and went back, but as you can see, the price level is not yet back 6 years. It's maybe about up 4. So where is it? I'm not sure exactly. This is a little bit of a function of the pound actually coming down as well. So you can see the Hong Kong going up as Hong Kong's currency is pegged to US dollar. Down here, there's only one country where the market has gone down to the point of about 7 years. And that is our orange line in the United States of America. So, there's only one country that's bottom. Everything else is at the top down here. So let's look a little bit more in depth. We've been drilling down here. US housing real estate, as you can see, went up here, has come back down here, and back to about 2000 levels. If it bounces a little bit more, it will be 2003. About that cycle of about 7 years, 7-8 years price regression. Is it back down to 1972? No, it is not. So that's a very key point. So just remember on this slide the lines here, the trend lines. I'll get back to that right at the end. But here's the point here, market's down, buy at the bottom. Now, moving forward, the second point down here is lack of opportunities in the region. Basically, too much money chasing too few deals. What am I talking about down here? Take a look at a cross-section of asset classes in the entire market, right? We've got on the left side the equity guys, STI index, 2.87 dividend yield. Now I don't know what you guys say about capital appreciation, but you know, stock prices have a lot to do with dividends. Second point here is the S&P 500, which is 1.97. Very strange. US companies on the S&P yielding lower than Singapore in the emerging market. Now, this red line here, yes, it's kind of like an average of this line over here, but that's actually like almost the inflation line. So you're doing all this investment over here, and you're below inflation. I mean, what's that about, right? So this part of the world, right? Here's the point. In Asia, there's a lot of capital. Savings rates are very high. Banks have lots of money. They are not short of making out capital. So you want to be investing in a place where people are short of capital, where they need your capital. So, I mean, let's get the point down here. I mean, go into Singapore savings rate at 0.25 and 0.5 fixed interest rate. I mean, that's really low. The bank is actually telling you that at this point here, like I said, at 0.5, the bank is really telling you, we don't need your money. Keep your money. We got too much of it. We're going to give you 0.5. We're going to give you a very low amount. So, moving on, Hang Seng, we've got the S&P Australia at 4%. The whole region in Asia is giving very, very low returns. Lots of cash down there. Up there, moving on to, let's see, it's 5.3, is London's W8 down there. I actually got that number from you know, have you seen these ads where they give you guaranteed rental return? Yeah, so I picked that one up on the newspaper at 5.3, somewhere in London's W8. And 4.5 is actually Melbourne, same thing down there. So they've got what we call guaranteed return. So I'm not quite sure what actually that means, because it's kind of like this. Someone gives me $1, and after 1 year I give them 5 cents back, and after the second year I give them another 5 cents back. So that's what you mean by guaranteed return. It's not an open market. It's not someone else renting your place down there. You're getting a rebate, kind of like right now with the stamp duty. So with all this kind of stuff going on here, we've got all this rental. I actually had a slide on about the Pongo property, but there's only one figure here that looks kind of interesting, and that's down here at US Tampa property. So just remember that number. We'll get back to it and try to explain exactly why that's 12.2%. Here, very low, a lot of capital, don't need your money. So this is an illustration down here of all the returns on rental yield. As you can see, China 2.6, Singapore 2.94, hardly even covering your expenses and your interest rate. The only guy that's interesting is Indonesia and Philippines, but if you make an investment there, you may get 10.21 some of the time. The rest of the time, maybe you're not going to get your money back. So just remember that. Why are emerging countries having such low returns? The risk that you're taking. Next point, real economics, demand and supply. We're going to go back. Very simple. U.S. products still in demand. The U.S. economy still has products we all want. How many people here have a product from the U.S.? Easily everybody. You use Apple, you use Google, you use Microsoft, anything down there. So you need their products. How many people here have a Greek product? Silent, nice. Just don't be shy, you know, you got some couscous or something in there, yeah, just shout it out. Any products from Ireland? Any Ireland? So, here's the bottom line down here. The US has products that you want. And as the dollar comes down, people are going to be buying more of these products. In fact, Apple had a stellar year. A little bit function of US dollars down there. So if you've got Apple, Coke, and Google, you've had tourism absolutely going through the roof. You've got export industries doing very well in South America and Canada because of the proximity to the US. So I don't know what's going to happen in the financial situation, but as long as you have products that people want, you are able to sell something and get something in return for it. That's very important. Guys in Greece, Ireland, and in Spain are going to struggle to get out of this because they have nothing that you want. So this is a very, very interesting point down there. So, as I said, we're going macro, we're going to go micro and figure out where in the US we want to be investing in and where is Wesvault actually in. Now, as you can see, we are actually looking very closely at Florida. Why are we looking very closely at Florida? I mean, there's a couple of reasons, but the first point I want to dispel is not an old state. Okay? I've spoken to a lot of people, they think that in Florida there's nothing but old people hanging around. Okay? I don't know why, I've seen that. So, haven't you seen CSI Miami? First point is Florida has a GDP of 747 billion. It's the fourth most highest GDP in the United States. This is an unbelievable fact because that will make it 20th biggest economy in the world. So they're doing pretty good for a lot of old guys. But other than that, this is huge. I mean, if someone tells you buy a property in Phuket or Batam or one of these countries, they have nowhere close to GDP amount of Florida down there. If you're a big GDP, sooner or later you're going to get out of the rut because no one can ignore you. Where does this GDP come from? I mean, key trading state with Latin America will trade. Very big US trading with South America. You can see the location it reaches right down there. Key tourist destination. In fact, it's so key that it's the top tourist destination in the world. I'm serious. Very big. Where is all this tourism coming from? Generally all from the US. So you've got your local market already supplying Florida with tourists. Think Disney World. Think convention centers. Think everybody flying there over winter. Very big one there. We've got some good agriculture going there. Orange juice, you know, Florida's natural, very, very big. Agriculture is one of Wesvault's one of the 4 teams. So we're big in this area, that's why I mix that around. Sugarcane, biggest supplier in North America. Another point down here is the land size. You got a land size of the 22nd largest, but your population is the 4th. So you see the point there, very small space, very large population. And finally, why are we in Tampa Clearwater is that it's second most populous in the entire state. Now I'll tell you why we're not in the first most populous. So that's Tampa, right down here. If you want to make an investment, I do not like to go to very cold places. So if I like this nice location there. Nice coastal areas. If you're buying property, you want to be near the coast first and foremost because coastal properties hold their value. Don't try anything too central. And if you're Singaporean, you really need to be next to the coast. And really, it's not so bad. Heck, we actually like it like that. A lot of people have been putting down the US lately. Say it's a very mean place, you know, so the debt's out of control and all that kind of stuff. But first and foremost, prices are down to trend line. They are not back down to 1960 or 1920. In fact, they're exactly where they should be, where property prices should be going up, along the trend. Now, in fact, I don't really care about all the noise coming from CNBC. You know, housing starts are down, economy bad, I don't know what Obama's up to. Because if you're a property investor and you're getting 12.2%, you actually want real estate to stay low. You want it to stay at that price because you're trying to buy more property. You're not interested in getting the capital appreciation. What I would like is, you know, for it to keep straight, like what Singapore did, you would pick up all the property and then it goes up. So luckily that looks like what's going to happen down there. You do not want it to recover like what Singapore did, like straight up like that. So why so unhappy? Only Americans are unhappy because they've currently got a house. So they want their price to go up. The next point down here is that property supply and demand. Supply is going down. Nowhere? It's going down. All the houses that no one is building new property in the United States. There's no financing available. Who will want to do that? So if you've got a limited amount of supply and it's slowly being absorbed, sooner or later you're going to have prices going up. And this graph completely illustrates this point. It's going down at the point down here at the lowest point right now. So that's in Tampa.